Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle. He is the U.S. economist at Nasdaq, and we're going to take a look at current valuations, which suggests that they are in line with historical trends at current interest rate levels. Michael, it's great to see you as always. Welcome back to Trade Talks. And I want to start with what we've seen over the past week in terms of market activity. And one week we were talking about bad news is good news. Now we're talking about good news is bad news.
Right. So this week we had a case of good news is bad news, where the good news was the jobs report, where the economy added 263,000 jobs against expectations for 250,000, and the unemployment rate the unemployment rate fell back to 3.5% as the labor force shrunk. So the good news is that we have still a strong labor market, but that means that the Fed's efforts to cool the labor market hasn't worked yet, which will have wages keep upward pressure on inflation. And so the Fed will have to keep at it with their rate hikes, which of course is bad for valuations. And then we also had the U.S. ban exports of advanced semiconductors chips to China, which weighed on the chips producers. So we saw the Philex semiconductor index down about 12%. So that added to the sell-off. So all told, the major indices are down about 4 to 7% over the last week, and 10-year Treasury yields are up about 30 basis points to 3.9%. But we're coming into earnings season, so markets might now have something other than just economic data to focus on.
And Michael, let's talk about earnings season as we kick it off in earnest this week with the big banks. We saw Pepsi numbers today as well. Do you think we could potentially see a sign of earnings recession here, or do you expect them to hold up relatively well?
I think we're looking okay from that perspective right now, because we're expecting to see positive earnings growth for Q3 and Q4. In Q3, it's going to be, the current expectation is just over 2%. Q4 will be a little below 4%. But of course, that is a big downward revision from where we expect to be just 3 months ago. Back then, we were expecting Q3 to see about 10% earnings growth. But that, since then, we've seen the economic slowdown continue, and companies have been dealing with excess inventories. So the downward revision has come pretty significantly from there. Plus, revenue growth is expected to be about 9%. So with revenue growth being so much stronger than profits, that suggests that higher costs are eating into those profits.
And Michael, the next chart that we have here is what really caught my eye, because you're saying it suggests that valuations are in line with historical trends with interest rates at current levels that they are right now. Explain to us what we're looking at here.
Right. So the market is down about 25% year to date, and we've seen PE ratios drop about 20% over the last year, while 10-year Treasury yields are up about 240 basis points. And so we've kind of moved from the upper left-hand corner on that triangle to the lower right-hand corner. And since we're staying below that trend line, that suggests that stocks are not expensive relative to their historical trend. But that doesn't necessarily mean that we can't see a larger sell-off.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.